Hi and welcome to Swissquote's Daily Market Talk. It's Monday, 18th of May. Global yields are soaring as rising inflation due to higher oil prices force investors to rethink the outlook for central bank policies, while European Central Bank expectations were already pointing at the possibility of summer rate hikes. The Fed funds futures have now started pricing in more than a 50% chance of a December rate hike in the US, which is a stunning reversal from expectations for multiple cuts earlier this year. With equity valuations stretched and borrowing costs rising fast, a market correction now looks inevitable. So we will talk about that and more. But before we do, and as always, please keep in mind that opinions are my own and this is not financial advice.
This show is brought to you by Swissquote.
So the big story and the dominant market driver since last Friday has become the rapid sell-off across sovereign bond markets as bond yields in major markets, including the US and Japan, soared last week on a set of inflation numbers there showing that inflation accelerated faster than expected by analysts, and that was obviously due to the Middle East-led energy price pressures. Now yes, it was predictable, and the funny thing is there's always that pivotal moment in the market that provides the aha moment to investors, and last week that aha moment came with inflation numbers from major economies again, including the US and Japan, while oil prices also kept rising due to no progress whatsoever in Iran peace talks and the fact that the Strait of Hormuz remains just closed. And while this Monday the bond stress remains on the headlines as US crude traded past the $108 per barrel level earlier in the session and is consolidating just below this level at the time I'm talking here, with upside risk outweighing as the prolonged Middle East conflict leads to a record decline in global oil reserves. As such, the Japanese 10-year yield hit the 2.80% level earlier this morning before bouncing lower as Nikkei sold off another 1% following last Friday's sharp 2% retreat, also dragging major US and European indices down with it. The technology stocks that have been performing quite well since weeks took a hit simply because they have been carrying the latest rally on their shoulders. In China, the latest economic data looked particularly bleak, with an unexpected fall in investment, an unexpected deceleration in industrial production, and a worrying decline in retail sales growth to almost none in the month of April, mostly due to a 15% plunge in car sales. The weakness was mostly explained by heavy disruptions due to the Iran war, whether we are talking about supply chains or the energy transport. And last week's US-China summit led to a certain number of trade deals that sounded kind of positive, especially in agricultural goods, while China has reportedly refused to buy Nvidia's chips as they now want their own chip makers to take the lead. Another sign that the market narrative is now changing hands from the US to other countries, and that the US is no longer the all-powerful and only decision maker. Alas, even that couldn't give a smile to Chinese technology stocks this morning. The SMIC, which is one of the leading Chinese chip makers, is down by almost 5% at the time I'm talking here, with the Hang Seng Index also slipping below its 50 and 200-day moving average in Hong Kong today. Unsurprisingly, US and European futures are also in the red this morning, and the bearish mood is justified. The rising inflation fuels hawkish central bank expectations, fuel the expectation for higher rates, and weighs on valuations. And this does make sense. What did not really make sense since a couple of weeks now was the major indices rallying to all-time high levels when investors knew that inflation was going to be a problem as the Middle East tensions prolonged. But well, strong AI earnings and solid guidance from these big technology companies somehow outweigh risks, while CEOs of non-technology companies seem worried that the energy crisis that the world is going through today has indeed started eating into people's purchasing power. Now, this setup is in place since more than 2 months now, and the central bankers have already expressed their view on what's coming. The RBA raises interest rates. The ECB is expected to hike rates as soon as next month. Some hawkish voices are also coming loudly from the Bank of Japan today. The Bank of England is also on a slippery ground, with gilt yields also being pressured by political earthquake there. I wouldn't really touch sterling nor for the UK gilts at this moment because there is just too much political uncertainty. They are making the fiscal policy path very uncertain in a country where growth and productivity are both notably under pressure. And finally, in the US, well, there is a big shift. The probability of a December rate hike is now being priced in at more than 50%. I will repeat this. Activity on Fed Funds futures is presently pricing in a 25 basis points or plus rate hike at more than 50% for this December in the US. And that's a big shift for the Fed that was expected to keep rates steady. And remember, before the war started in Iran, markets were expecting that the Fed would cut the interest rates this year. The White House even chose Kevin Walsh as the Fed's next chair, partly because he was seen as someone who could help deliver lower interest rates. And well, a few days before Walsh takes over the helm of the Federal Reserve, markets are now pricing in a more than 50% chance for a December rate hike in the US instead. And that's not great news when equity prices are flirting with all-time high levels and valuations are already looking stretched. Take Nasdaq 100 for example. Its PE ratio today is above 38, meaning that a correction would actually be healthy to bring these valuations back to a more reasonable, a down-to-earth level. And if the Nasdaq 100's PE ratio were to move back towards its historical range, that would be somewhere around 25 to 30 times its earnings, well, it would likely imply a meaningful pullback in equity prices unless earnings growth accelerates fast enough to justify the current valuations. How meaningful? Well, if we take pure maths, a move from PE ratio of 38 to 30, for example, would imply roughly 20 to 22% correction if earnings expectations stay unchanged. And assuming that earnings will also grow due to the AI adoption, a correction of 10 to 15% may actually be reasonable, and that would bring Nasdaq 100 toward the 23.6% Fibonacci retracement level on April 2025 to today rally. That's near 26,600 level, and to 25,200 level, which would be near its current 200-day moving average. And in theory, such retreat should not even reverse the positive trend that we see in Nasdaq since last year, which will remain intact above the 24,800 level, which is the major 38.2% Fibonacci retracement on the past year's rally. But it would take some air off the index to allow a healthier path north afterwards. Now this week, focus will be on Iran and Strait of Hormuz, of course, but also on the UK's inflation data, FOMC's meeting minutes, and the flash PMI numbers across major economies around the world. On the earnings front, Nvidia is due to release its earnings on Wednesday this week after the closing bell. Now, Nvidia's results have been one of the most important cues of an earnings season about the health of the AI growth since years now, but it's no longer the most important cue. Nvidia chips are still the best in the market for training complex AI models, but running them requires CPUs and memory chips. This is why the traditional CPU and memory chip makers like Intel and Micron, for example, have been gaining faster compared to Nvidia in terms of their stock price since months now. And this is also why the Korean memory chip makers have been taking over the headlines. Korean Samsung, for example, this year is expected to earn around $220 billion in revenue. That's just under what Nvidia is expected to earn. So I believe that Nvidia earnings this week could maybe divert investors' attention from the geopolitical worries and the soaring bond yields due to rising inflation. But the bar is set very high today when it comes to Nvidia's results, and an earnings beat alone wouldn't automatically lead to a positive market reaction, especially across the global financial markets and across the global technology stocks. What technology companies also need today is a more stable and predictable macroeconomic setup, and that doesn't look like it's on the menu du jour for now. So this is all for this Monday. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below, as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow, and until then, good day trading.
Trading and investing carry risks, including capital loss. CFDs in digital assets are volatile and not suitable for everyone. Swissquote assumes no responsibility for accuracy or losses from its use. Products and services are offered only where legally permitted.